If you have no clue how to pick stocks or even what factors to consider before buying a stock, then this video was made for you. I'm gonna explain the 4 key metrics to look at in a stock before you risk your hard-earned money on any investment. Understanding these metrics will make it easy for you to distinguish between a shitty investment and a great investment. I'll also show you where to look up this info so that by the end of this video, you'll be able to do your own research at home. If this sounds good to you, then keep watching. The first factor to consider when buying a stock is whether the company has a competitive advantage. This is called an economic moat. The wider and deeper the moat, the safer the castle is from getting attacked. This moat is a company's ability to protect its profits and its market share from competitors. If you don't have a moat, competitors will cut into your profit margins, steal customers, and eventually put you out of business. So never invest in stocks without a moat. Because for long-term investing success, you need a company to be around in the future. And the only assurance that the company will still be around in the future and that your money won't be lost is its moat. It's a competitive business environment out there, so you want to invest your money with companies that have really wide, durable moats. Coca-Cola has been around for so many years, decades, and they have an unbelievably strong moat. There's tons of competition making generic copycats of Coca-Cola, of the drink, but because of Coca-Cola's iconic brand name and its worldwide distribution network, they've maintained fat profit margins for the last century, despite there being all kinds of Coke imitation drinks out there. Coca-Cola's moat shows in the stock price. If you'd invested in Coca-Cola years ago, you'd be a millionaire. So moats come in many different forms, and Coca-Cola's moat was due to brand name and economies of scale. So they had 2 sources of moat. Other types of moats are trade secrets. For example, when a company has a patent or some sort of secret way of making a product that their competitors can't copy. So one example is Align. They make a retainer kind of product called Invisalign, and they have patents on this product. So that's one example of a trade secret moat. Another source of a moat is network effects, where everyone is using that product, and because everyone is using it, it just makes the value of that product even more valuable. A perfect example is Facebook. Because everyone else is on Facebook, you also want to be on Facebook because that's how you stay connected to everybody else. And because everybody's on Facebook, everybody needs to advertise on Facebook, and so on and so forth. So that's what you call network effects. Another type of moat is a toll bridge moat. So back in the day, you can think of a traditional toll bridge where in order to get onto this road, you need to pay that toll. There's just no other road out there that will get you from A to B. So an example in the modern world is Google. Because they're the #1 largest search engine in the world, if you want to advertise and reach all those people who are searching on Google, you need to pay Google to advertise on there, to access all those people. So that's kind of an example of a toll.
I don't understand.
What the f***? My Google Assistant just responded because I talked about Google, and that was really scary. That just scared the out of me. Another example of a moat is a cost moat, where that company has the ability to have lower costs than all of its competitors, so that allows it to either sell at a lower price or maintain bigger margins. So an example of this is Walmart. Walmart is such a big buyer that they are able to demand lower wholesale prices, which in turn allows them to charge lower retail prices and also maintain good margins. So as you can see, there's a lot of different ways to have a moat: toll bridge, lower costs, network effects, a brand name, a brand presence, economies of scale. So before buying a stock, you want to always ask yourself, what type of moat does this company have? And then you also want to ask yourself, if it has a moat, how durable is this moat? And if you can't think of anything, then chances are it doesn't have a moat. And if that's the case, you should cross this stock off your list and move on. The second metric to look for is profitability. Before you invest in a stock, you also want to consider, is this company profitable? The best way to measure profitability is with a metric called return on capital. Return on capital is net income divided by invested capital, and it's expressed as a percentage. You can either look up the financial statements and calculate it yourself, or just get it straight from online data sources like Morningstar.com. Return on capital is important because it tells you how good a company is at generating profits, given a fixed amount of resources. Yes, profit is great, But what's more important is how much it costs to generate that profit. Because what if I told you that my business made $100,000 of profit last year and there was a total of $10 million invested in the business? That's a 1% return on capital. It's not good. That's not a special company by any means, and definitely not one I'd consider investing in. On the other hand, what if the business made $100,000 of profit last year on only $10,000 of invested capital? That's 1,000% ROC. Whoa! Now that's a special company. So companies with high return on capital do a lot with a little, and companies with low return on capital do a little with a lot. So if you're considering a stock with high return on capital, it probably means it has a strong moat and you'll be getting a lot of bang for your buck with that investment. So as a rule of thumb, you want to look for high return on capital when buying a stock. Now my examples were a bit exaggerated, so you'll probably never see anything with 1000% return on capital, but anything in the high teens or double digits is good. As a point of reference, Coca-Cola has return on capital in the 20% to 30% range, and they've maintained that for many, many years. So that's pretty exceptional. 20% is great, 15% is good, anything below 10% is questionable. And you definitely don't want to see a return on capital that's negative. The third thing to look for in a stock is price. So you found a company that you understand, it has a moat, and it's profitable as measured by the return on capital. But you don't want to just buy it at any price. Even the best investment becomes a horrible investment if you pay too much for it. So this is where the PE ratio comes in. The PE ratio is a metric that tells you how expensive or cheap a stock is relative to the earnings it generates. Here's how it works. PE ratio equals the current market price of the stock divided by the most recent reported earnings per share. That's why when you talk about stock price, you always want to look at it relative to earnings. Generally, when you're looking to invest, you want to buy stocks with low PE ratios. Especially if its PE ratio is usually higher, but it drops for whatever reason, that means the stock is trading pretty cheaply relative to where it usually is, and it's probably an amazing bargain. PE ratios are super useful to know about because when you buy something cheap, you reduce your risk by a lot. Like if you bought something cheap at a low PE ratio, there's not a lot of room for it to get much cheaper, right? Whereas if you buy something expensive or a stock with a high PE ratio, there's a higher chance of it going down and it's not as safe of an investment. Now, I've made a stock investing checklist cheat sheet for you that you can reference. It tells you exactly where to go, how to calculate all these numbers that we're talking about, and what the numbers mean, so you can reference it when you're doing your own research on a stock. So if that sounds cool to you, you can click the link below to download it. It's super useful. The fourth metric to look for when looking at stocks is debt. Before investing, it's very important to consider how much debt a company has. Most companies have debt, so although debt isn't necessarily a bad thing, it is a double-edged sword. As long as a company has enough cash flow to pay the interest and principal on its debt every month, then debt is just part of running and growing a healthy business. Sometimes you need to borrow money to grow. But what you don't want to see is a company with boatloads of debt on its balance sheet, and it owes so much that it would take forever to get out of debt. Or it even borrows money to service its existing debt. These are red flags you definitely want to watch out for. Here's how you assess debt. So you look up long-term debt and free cash flow, and these are numbers you can get on morningstar.com, or you can check out my PDF download below to see exactly where to find them. And you want to divide long-term debt by free cash flow. And I call this the debt payback number. This number basically tells you how many years it would take for a company to pay off its long-term debt with its cash flow. And a good rule of thumb is 3 years or less. You don't want a company that's gonna take like 10 years to pay off its debt. Highly leveraged companies or companies with a lot of debt are risky because if for whatever reason there's a downturn and revenues fall for a while, that puts the company in very shaky territory because its debt payments are fixed while its revenues are variable. If a company can't make its debt payments, it's gonna have to declare bankruptcy. And that could mean the stock price goes to zero and you lose your entire investment. So if you just stick with conservatively financed companies, then you'll be fine. What stocks have you thought about buying and why? Join me in the comments below and let's motivate each other to get started investing. If you liked this video, hit that subscribe button below and share this video with your friends so we can open up the conversation around money and build a sisterhood of financially empowered, savvy women. Always remember to go after your dreams unapologetically and to live life on your terms. Cheers.